Australian share market comprises only about 2% of the global share market. It's also heavily concentrated in the materials, that is, resources, and financial sectors, with little exposure to the huge technology and automotive sectors. Despite these and other shortcomings, many Australians don't take full advantage of the significant diversification benefits offered by investing in international shares. The home country bias exhibited by Australian investors is not unique. It occurs in most countries. It implies that the cost of familiarity for such investors is that they are taking more investment risks than required to earn their expected returns. The investment diversification ratio is one of FinHealth's 5 key indicators of good financial health. It advocates that you should diversify as broadly as you cost effectively can to reduce investment risk. Allocating a meaningful percentage of your chosen allocation to growth assets to well-diversified, low-cost international share funds is consistent with this approach. In the rest of this video, we examine the risk reduction benefits of holding international shares as part of your growth assets. We also consider how you should respond to the exchange rate risk inherent in investing in international shares. Hi, I'm John Lesky, recently retired personal financial advisor and founder of FinHealth, a tool to guide you to your financial independence. Now, the chart on the screen shows the growth of $1,000 invested in both Australian and unhedged international shares for the 31-year period June 1991 to June 2022. Well accepted, highly diversified indices of market performance are used for the return calculations. The chart reveals that Australian shares outperformed international shares over this period by 1.4% a year. And using a common measure of investment risk, volatility, as measured by a statistic called standard deviation or SD, did so at a considerably lower level of volatility, that is 12.6% a year versus 16.2% a year. The conclusion that some Australian investors draw from this historical experience is that international shares perform worse and are riskier than Australian shares, so why bother with them? But, as we are constantly reminded, past performance isn't a guide to future performance. Looking forward, there isn't any sound and obvious reason that I'm aware of to suggest that Australian shares will continue to outperform international shares. If there was, markets would quickly adjust to take advantage of this expectation. But what about risk? Historical standard deviation tends to be a more reliable measure of future volatility than past returns are of future returns, but it's not infallible. However, rather than trying to choose the winning share asset class based on history, let's have a look at how a more highly diversified 50% Australian shares, 50% international shares portfolio, rebalanced annually, performed. The chart now shown adds the diversified portfolio to the previous chart. Perhaps unsurprisingly, the annual return of 8.6% is approximately a weighted average of the returns of Australian shares at 9.1% a year and international shares at 7.7% a year. This weighted average return experience can be expected in the future. But what is most important to note is that the standard deviation of the diversified share portfolio of 12.8% a year is less than the weighted average of the standard deviation of the individual share asset classes of 14.4% a year. Unless, in a most unlikely event, the future returns of Australian and international shares always move exactly in tandem with each other, this volatility reduction benefit of diversification will be there for the taking. It's sometimes called the only free lunch in finance and is a hallmark of efficient investment risk management. In summary, you're taking more investment risk than you need if you're not cost-effectively highly diversified. But having decided to invest a percentage of your growth asset exposure in international shares, what do you do about the inherent foreign currency risk? We suggest you either bear it, that is, invest on an unhedged basis, or purchase an international share fund that provides full protection against currency movements, that is, fully hedged. We wouldn't advocate taking active currency bets, that is, swapping between unhedged and fully hedged holdings of international shares based on your views regarding whether the Australian dollar is likely to generally strengthen or weaken against foreign currencies. This is more akin to gambling than it is to investing. Our preference as a long-term investor is to invest in international shares on an unhedged basis. While short-term returns will almost certainly be heavily affected by volatile currency movements, over the long term, currency movements tend to have little impact on real, that is, after inflation, investment returns. This is borne out by the chart that's now shown, which is the annualised movement in the Aussie dollar against the US dollar, and it could have been any currency, for the following rolling periods for 12 months, 5 years and 20 years, from 30 June 1969 to 30 September 2022. It shows that over 12 monthly periods, the green line, exchange rate movements are extremely volatile, varying between plus 40% and minus 30% for the period shown. Such swings can completely swamp local currency returns on international share investments. For 5-year periods, the blue line, exchange rate volatility reduces considerably, but it can still massively affect the currency adjusted returns on international investments. For the 5 years to July 1986, the Australian dollar fell 12% per annum against the US dollar, enhancing the return on US share investments when converted to Australian dollars. Conversely, for the 5 years to October 2007, the Australian dollar rose 10.7% a year against the US dollar, so that US share investments fared much worse in Australian dollars than in US dollar terms. But the key takeaway from the chart is that at 20 years, the red line, volatility largely disappears. For the 20-year periods ending 30 June 1989 to around March 2001, the Australian dollar depreciated about 2 to 4% per annum against the US dollar. Most recently, no clear direction is evident. Economists argue that over the long term, exchange rate movements must largely reflect actual and expected differences in inflation between countries. Since about December 2004, the Australian dollar has been appreciating against the US dollar on a rolling 20-year basis between 0 to 1% a year, suggesting the US inflation rate has been slightly above Australia's over the period. Long term then, exchange rate movements primarily serve to adjust relative prices between countries. They seem to do a reasonable job, despite the fact that, short term, they could do anything. Serious long-term investors understand that currencies are not investments. They do not have expected long-term real returns, and they have no impact on expected risk-adjusted real returns of international shares. They are comfortable ignoring short-term exchange rate volatility. However, a fully hedged exposure to international shares does provide you with the diversification benefits discussed earlier. If short-term exchange rate volatility threatens your resolve to maintain long-term investment discipline, perhaps it's a better option than no exposure to international shares. It's natural to feel more comfortable investing in assets that you're familiar with. It largely explains why Australian self-managed super funds hold the majority of their investments in Australian shares, residential investment properties, and Australian bank term deposits. But familiar doesn't mean less risky and, in many cases, can be a more risky alternative. Efficient investment risk management requires you to spread your investment bets as broadly as possible. An allocation to broadly diversified international share funds is an effective way to diversify your growth assets. They may hold thousands of shares, many of which you may not know. Any concern about a lack of familiarity should be countered by the fact that in widely traded, transparent international share markets, there are a myriad of independent investment experts seeking to take advantage of any apparent divergences from assessed fair value. You can rely on markets to do the due diligence for you. Hopefully, you found this video of interest. I'd like to know what you think. Please provide any comments or questions below. And finally, thanks for watching.